Hello, this is Craig Larson with Larson Financial Advisors for the Market Minute on August 26, 2015. Well, are you awake yet? The last week has had a sudden spike in volatility in U.S. stocks, and in case you haven't been watching the news or you've been living in a cave, the market dropped 11% in 3 trading sessions and has bounced back about 4% as of this recording on Wednesday, the 26th. So a quick note on that, markets don't move in a straight line very often. There's definitely a sawtooth effect to it. So after a really big move, things have a tendency to bounce. So today's bounce is expected. Short-term indicators on markets are really oversold. It's just the rubber band has been stretched really far in one direction and it's snapping back a little bit. And this rally is going to tell us a lot about the health of the market. Right now, from a long-term investor perspective on our rankings, U.S. stocks is still in first place. Bonds is still in second place and has picked up trend strength. International has been crushed in the rankings and is now down to fourth place. What went into third place? Money market cash equivalents. So a category which pays virtually no interest at all is now ahead of international stocks. So it just shows you how badly the trend has deteriorated in international. Now in U.S. stocks, as we've talked about for many months, way overvalued, high margin debt. It's been a potentially risky situation which is now manifesting in reality. And from trend indicators, the percent of U.S. stocks on a buy signal now is below 50% and falling. The percentage of U.S. stocks on a positive trend is below 50% and falling. So you can say now, just as a general assessment, that the glass is less than half full and it's continuing to leak. So although short term we're due for a bounce, the long term picture does look pretty grim and risky. So be very careful out there. We are on a 7-year cycle where that 7th year tends to present some real challenges in markets a lot of the time. Crash season in stocks is September and October, and we talked about that in the last video. If you want to recap on that, please listen to the last one. But it does appear to be a very risky time frame in general, and now the trend indicators are corroborating that risk. Now, another thing that we look at for longer-term investors is fund scores. And fund score is an algorithm that takes into account a lot of different data and charts and buy and sell signals, and it comes up with a number between 0 and 6. If something's 3 or above, we tend to like it. If it's below 3, we get suspicious. The really strong trending things are 4 and 5. So right now we've seen a lot of the U.S. stock funds deteriorate to below the 3 level, which is generally our sell threshold, and inverse stock funds as a category is above the general diversified U.S. fund now. So another risk signal. Things like emerging markets and developed markets international funds are in the below 1 score category, so extremely weak. Just a generally kind of a dangerous situation out there in the markets. Now, there's a couple interesting things with malfunctions that have happened lately on the actual exchange stock market mechanism. You may remember back on July 8th, the New York Stock Exchange was closed for 3 hours because of a computer glitch that was never really fully explained. And Monday morning, there was some malfunctions as the market opened. So some orders were filled at extremely low pricing within seconds of the open. So just as an example, the iShares S&P 500 fund, which is a widely traded S&P 500 index fund, opened at 188 per share and within seconds was trading at 150 per share. And then when things settled down after several minutes, bumped back up to kind of its normal price range. So one cautionary tone I would make out there is one needs to be very careful with how you place trades and when. And just note that we think that we can just go on our computers and trade things when we want to, and sometimes we can't. Sometimes exchanges are closed or they're malfunctioning, and so it's just, to me, it's just another bad omen about some unsettling undercurrents and things right now to watch for. And I think finally, we've talked about risk management and having a risk management plan on these videos for well over a year. And risk management is kind of like fire extinguishers. When there's a fire, you need your fire extinguisher right there on the spot for it to be effective. And if you've got a fire and you spot it and you decide, well, I need to go to Walmart and I'm going to drive over there, buy a fire extinguisher, come back, and then extinguish the fire. It just doesn't work like that. Your house burns down before you get home. And it's somewhat similar in markets whereby as investors or as an advisor, I've got risk management plans on all the holdings in a portfolio. If you're an investor and you don't, it can be too late really quickly to do anything about it. So anybody out there that's listening and you have any questions about, well, how do I risk manage? How do I hedge? How do I protect things? Please call or email, and I'd be glad to go over that with you and see if we can help you out in some way. But thanks for tuning in today, and enjoy the rest of your week.